Investing is simple but not easy. There are lots of things that one needs to keep in mind while starting their investment journey. Today we're going to look at the 12 top mistakes people make while they start their investing journey and how we can avoid them. First, be clear about the goal that you want to reach. That really is the first starting point that one needs to look at. Without a clear goal and a plan in place, you tend to choose the wrong investment and you tend to make investments over an elongated period of time. So first up is to find a clear goal or a plan that you want to achieve based on your investing. Second, you must ensure the investments that you do are aligned to your risk temperament. Each of us are built differently. We have different risk temperaments. Some of us like high risk, high return. Some of us don't like high risk. We prefer to be more safer. So depending on your investment temperament, you need to make sure that you are aligned to it. So avoid jumping in for the investment that gives you highest return. Align it with the product that is aligned to your temperament. Third, always look at diversifying investments. One of the things people make is they love to put all their money in the place where they've had an earlier success. So if real estate gave them great success in the past, they keep all their monies there. Or if equity has given them great returns, they only stick with equities. The real truth is there is nothing like diversification. So one needs to look at diversification if they want to avoid concentration risk. So ensure your portfolio is adequately diversified. You may still have a liking for one asset which may still be a larger chunk of your portfolio, but it should not be the only thing in your portfolio. That's where diversification plays. The fourth, people often look at the past performance, especially while investing in mutual funds. They look at the past performance and make investments. Unfortunately, past performance is only one of the indicators. There are a variety of different indicators one needs to look at before one does investing. So you need to look at the fund manager's track record, the fund house's strategy, that specific fund's performance strategy and past track record, and various other factors before deciding to go ahead with investments. Fifth, cost and fees. Some of the investments are passive investments in the form of index funds. Some of them are managed by fund managers and take higher risks, and their fees are also higher. It's very important to align yourself with the kind of fund based on the experience that you desire to have. This will also help you economize and efficiency on the cost that you will incur in managing of these funds. 6. Frequent trading. People often use mutual funds as a proxy for equity stocks. So they buy and sell very, very often. And this is not a great strategy for returns. So avoid frequent trading. Stay invested over a longer period of time. Find out the strategy that you want to deploy and stay true to that strategy of investing. 7. Review and rebalancing of your portfolio. Markets are not the same and economy is constantly changing. So it's extremely important, at least once in 6 months or once a year, one needs to review the entire portfolio and rebalancing. Lots of people just fill it, shut it, forget it. And that's not a great approach when it comes to investing in mutual funds. One needs to take stock of the situation and rebalance the portfolio constantly. Next, trying to time the market. We all believe that we are masters in predicting the stock market. So we always think the market is either too high or too low at various points in time. As a result, we are trying to time the entry into the market, and that's not a good strategy. No one has a clue about how the markets are going to behave in the short term. In the long term, of course, one can look at economic data and find out how they are likely to perform, but not in the short term. So the best way to rid of this is to straddle your portfolio over a period of time. Make tiny investments in the form of either SIP or a systematic transfer if you already have a lump sum would be a good way to enter the market rather than trying to time the market. Not a good idea. Looking at emotional outbursts in managing mutual funds. What do I mean by this? When markets become volatile, people exit hastily, and when markets are going up, they want to enter more and more. Avoid the emotionality investing. The idea is to stay true to the purpose for which one you're investing, your goals. Your goals need to determine what you want to do rather than any of the other things. So the emotional aspect of trying to exit when the markets are falling and trying to enter with more money when the markets are already heated up is not a great idea. The way to do that is, if you have a plan, follow through on the plan and stay true. And that way you'll avoid doing anything emotional. Ignoring tax efficiency. Mutual funds are products where there is a tax implication every time you enter and exit. Especially when you exit, there are tax implications in the form of capital gains, short and long term. So it's extremely important that you take care when you exit a portfolio that you are in the right frame of capital gains. Otherwise, the gains tend to eat into the returns that you make ever. So take tax efficiency into account while planning your strategy of either investing or exiting mutual funds. Very, very important, especially if you're on a high tax bracket. Ensure you stay on top of performance. Every single day we are bombarded by a set of news that hits us. Geopolitics is happening all around us. There is a Hamas-Israel war, Ukraine-Russia war happening, and all of this in some way is impacting the investment portfolio. So stay on top of news, stay on top of information. You don't need to be a market expert, you don't need to be an analyst, but staying on top of news gives you that little bit extra edge. Don't ignore. Last but not the least, in terms of simple products, you can think of doing DIY, do it yourself. But when it comes to a complex action that you need to do, you want to plan your entire life, you want to think, it's always good to take professional help. Do not hesitate to take professional help when you need a more comprehensive approach, and when the amounts are large, do not try and double guess it. Go to professionals who know what to do and who will be there to guide you in the process. I'm sure if you avoid making these 12 mistakes, you will ensure that in the long term, your portfolio will grow quite tremendously.